Have you ever noticed that there's a line on your income statement that reads bad debt expense? And that amount does not equal the amount of the accounts that you had written off during the year? Not to worry, all is fine. Today we're going to talk about writing off bad debts. We're going to talk about the GL account's allowance for bad debt and bad debt expense. So stay tuned. If you regularly sell products or services to your customers and provide them with payment terms such as 30 days, same as cash, you will find that once in a while they don't pay you. At this point, you call them, you write them, maybe you try other collection efforts, and you get very frustrated. You may just write the amount off that is owed to you and move forward. For instance, if the customer went bankrupt, there is almost no chance you're going to see any of that money again. Also, it may become apparent that the cost to hunt them down might be greater than the amount that they actually owe you, so why bother? Cut your losses and just move on. For the purpose of illustration, here are some fictional income statement numbers. So far, the accountant has not done any allowance for bad debt journal entries, but you do see a bad debt expense. When you look at the history of your company over a few years, you will start to see a pattern. In this example, the amount of write-offs is usually around 3% of the revenue amounts. I point this out because this is important. If your accountant is following GAAP, which is generally accepted accounting principles, he will take the historical patterns and make an educated guess as to what the appropriate bad debt expense should be. Let me explain something. By the time you realize the account is uncollectible, it is usually several months after the sale took place. According to GAAP, the bad debt expense should have been recorded not several months after the sale, but at the time you made the sale. Of course, at that point, you don't know which ones will be uncollectible. If you did, you likely would not have sold to that customer on credit. So the GAAP rules state, in short, that you need to estimate how much of your sales will be uncollectible. You should know that this is not an exact science. And when you discuss these numbers with your banker, they will be quite familiar with this process, and they will not be alarmed. If your actual write-offs are large, that is when you need to figure your stuff out. Using the example we just discussed, we might estimate that our bad debts will be about 3% of our revenue. We then take that percentage and apply it to future income statements. So far, I have shown you the income statement side of this. Let's take a quick look at the balance sheet. At the beginning of this period, the GL accounts looked like this. And during the period, we made an entry for 3% of revenue. While the expense side shows up on the income statement, the other half of that entry shows as a reduction in your accounts receivable balance. It is usually shown in a separate GL account. When you do actually write off an amount as uncollectible, it doesn't hit the income statement. That would be like getting hit twice for it. Instead, that charge goes towards the GL account allowance for bad debts. Once again, we have determined that the appropriate allowance for bad debt entry should be 3% of revenue. So we make the entry. And then, as you can see, we also write off more accounts as uncollectible. This pattern continues each period. If you find that the 3% is actually too large or too small, you can adjust that figure as needed. And keep in mind, I'm using 3% for these examples. Your number might be 1%, 10%, it might be different. I'm just using 3% for the sake of illustration. In our example, we calculated the bad debt expense by applying a percentage to the level of sales. This is not the only method. Here is another common method. Many times, companies will look at the level of actual uncollectible amounts and compare it to the raw balance of the GL account, accounts receivable. Let me show you how this would look. Using the same basic numbers as before, we can see that instead of 3% of revenues, what we see is 10% of the amount sitting in the balance sheet. There are reasons for this difference. One is that some of your revenue may be earned by selling to customers who pay the same day. These customers do not buy on credit, so there is not likely to be a bad debt associated with these sales. Another reason could be that you have several customers who pay within 15 or 20 days, even though they have 30 days to pay. This causes your accounts receivable balance to be a little lower than if they had waited the full 30 days to pay. Now, here is a common variation of this method. If you have accounts receivable reports that show the amounts owed in different columns, this is often called an aging report. The accountant might apply a different percentage to the totals of each column. The idea behind this is that the longer the balance remains outstanding, the greater likelihood that it will not be collected. Although the method of calculating the allowance for bad debt is different, the accounting is pretty much the same. I hope I have cleared up this process for you. It is not voodoo accounting. It is based on the rules that accountants should be following. Accountants are to follow GAAP, generally accepted accounting principles. What do you need to be concerned with? You should be looking at the actual write-offs that occur during the year. If you are writing off a lot of accounts during the year, you may need to examine the criteria that you use to extend credit to customers. That should be your focus. Now, good luck. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.